All right. Hello, everyone. Welcome to the first Collective Liquidity LP event. I'm Greg Brogger. I'm the CEO of Collective Liquidity. We are very excited to be presenting to you today our view of the late stage venture market generally, and of course, our fund's performance specifically. But first, I wanted to thank you all for being members of the Collective community and spend a couple of minutes letting you know how that community is taking shape. The natural first question is, who are our LPs at Collective? Well, you are employees of many of the best late-stage private growth companies backed by the most successful venture capital firms. Our companies are diversified across several key technology sectors. 73% of you are vice presidents or C-level executives in those companies, which means our community is a very special group. Already, given the nature and size of our LP base, we know more about the future direction of exciting new business models and critical new technologies than most venture firms. And that knowledge is being leveraged by Collective's investment team every day to know which companies are innovating and thriving. Portfolio companies like DailyPay are just one example. DailyPay now provides tens of millions of employees with access to their wages before their payday, providing those employees with much needed financial flexibility and reducing their need for expensive payday loans. The success of DailyPay's solution is evident in the fact that in November, Deloitte publicly confirmed the company had grown revenue more than sixfold in just 3 years. An example of a portfolio company on the leading edge of technology is Cerebras. Cerebras is among those at the forefront of building advanced AI computing systems. Their wafer scale engine with its 1.2 trillion transistors is the world's largest processor and greatly accelerates the speed of artificial intelligence, training, and inference tasks. Their growing success is clear from the fact that in 2023 alone, they tripled revenue. We would also like to welcome our LPs that have invested cash into our fund. The liquidity they are injecting into the Collective platform is critical to its operation. It is one of the primary sources of capital to fund LP redemptions, which in turn repay LP exchange loans. We thank them for seeing the unique opportunity the Collective Exchange Fund represents. Diversified, transparent, liquid portfolio comprised of many of the best late-stage venture-backed companies backed by the best venture capital firms. And lastly, I'd like to spend just a minute to share our vision for Collective. What we are so excited about at Collective is the unique way we are bringing unicorn employees and investors together. For the first time, unicorn employees can efficiently and effectively manage their risk. Rather than having to be all in on their company's shares, they can dial down their exposure, their risk, as part of a sensible, long-term financial plan benefiting them and their families. And on the other side of our platform, family offices and individual investors that have been without efficient access to the asset class are using Collective to easily dial up their exposure in order to achieve their targeted allocation to venture. At its highest level, what we are building together as a community, as a collective, is a risk management utility of sorts, one that serves the top decile of companies in the venture space, enabling employees, investors, and investors to easily increase or decrease their exposure and access liquidity at will. So now, with all that said, we'll take a quick look at the agenda. So Mr. Ankit Misra, our Chief Investment Officer, will work through the market updates, taking a look at what's happening with respect to volatility in the market, changes in valuation multiples, developments in the secondary market platforms that we leverage every day at Collective. We'll also then take a look at the fund and its philosophy and performance, and then we'll end with some questions that we've been getting from LPs that hopefully are of interest. And then Jeff Nazzaro, our Chief Capital Officer, will finish it up with some closing remarks. So,
thank you, Greg.
That said, take it away.
Thank you. So we'll spend some time talking about the market backdrop and the fund updates. Kicking it off with the market outlook. I think it's just a hard thing to do to predict the exact interplay of various market forces. But I would say one thing is clear to us at Collective, that markets will continue to be volatile. In some ways, there are sort of opposing forces on one hand, you have sort of headwinds from unsustainably high government spending, the pandemic era consumer savings depleting over time, the geopolitical set of tensions. And on the other hand, you have tailwinds, through the rate cut stimulus and the innovation happening in the economy, and just a greater focus on capital efficiency, be it corporates, be it even the government sector. And I think it's going to be interesting times to see whether there will be a soft landing or not, whether the enthusiasm in the markets post elections is going to continue. But I think it's prudent for investors to be very well diversified and be prepared for a variety of outcomes, because it's hard for anyone to take a singular sort of view on the market going forward. So with that said, would love to dive deeper into some of the themes which I think are really important to appreciate in the broader market backdrop. And the first one I wanted to call out is just the excess government spending that has led to debt levels that have not been seen since World War II, and with no sort of path to recovery in near term. And it's just remarkable that the U.S. is spending more on servicing the debt on its obligations than it does on defense, which was the biggest sort of spending sector for the U.S. government budget. Now, how long could we continue to add $1 trillion of debt every 100 days? That remains an open question, and that's why I feel, yes, there is short-term rally in public equities market that you've seen in post equities, but the longer-term outlook in general is driven by the health of the economy, and there are certain forces that we need to be cautious about as we make investment decisions. The other interesting takeaway of this spending has been the extent of impact it has on the GDP growth. For reference, U.S. spent around $1.7 trillion more than its revenue last year, which represented a shortfall of roughly 6% of the GDP. And that's compared to a GDP growth rate of 2.5%. So to put it differently, in some ways, GDP growth rate was just fueled by excessive government spending, which may not be sustainable in the long term. And in general, I would say sustainable growth in the economy has to come from productivity improvements and not really excessive spending. And this is where the continued AI innovation is going to be critical to sort of support the economy going forward. The other aspect, which I think is probably not a surprise to many of you, but we had this really extended zero interest rate era, easy money being available, which led to a lot of excessive household savings being accumulated during the pandemic and somewhat subsequently thereafter. But all those have really depleted, and the consumer demand is somewhat waning. And you see that in when you evaluate some company earnings calls like Airbnb lowering its guidance on demand because there's just lesser saving wallet share that's left out there. And also we take into consideration the impact it had on the consumer industry and the investments that we are underwriting. Switching gears to, in addition to the macro trends, what's happening to the valuation multiples. This is again something that I think we all have heard in the news and research reports, but if you look at the valuation multiples and how they have evolved from the peaks of 2020s and 21s, where the rounds were getting done in weeks, if not days, there was a market-wide correction, arguably overcorrection in certain segments. But I think where we stand today, it's fair to say that the multiples in the market have reversed to its long-term historical averages. Public markets appear to be reasonably priced now, and more importantly, growth is still valued. Not at all costs, but you do see a correlation between, for example, here, where you see the high growth median multiple of 10.6, that's for companies which are growing more than 30%, whereas the companies in the low growth, with a 15% threshold. So companies growing less than 15% on a median trade at 4.2 versus 10.6. So clearly, growth still matters, even though there has been a long-term sort of mean reversion in the multiples if you may. The other factor that I think matters equally is, just the importance of cash, right? Like I think when we are looking at a lot of opportunities at our investment committee, the path to profitability and the cash flow is extremely important consideration in addition to the growth. And over there also, like we see that, it's somewhat cyclical. You saw somewhat of a bubble in prior years, but now we are sort of reverting to the mean, and there's a greater focus on cash flow multiples as well. The other insight I wanted to quickly touch upon was, looking at our area of business where, we are focused on private markets, and in private markets, valuation multiples and the headline valuation does matter, but what also matters is the specific deal structure. And, when you peel the onion, the company may be raising capital at the same price as last round from, pre-correction era or a slight premium, but we're just seeing a lot more companies doing, non-market deals such as higher liquidation preference or participating preferred and cumulative coupons and warrants attached to investments. And those are all like just exotic ways how investors try to extract more economics from their investment outside of the upfront valuation. And that again is sorry, Greg, looks like you wanted to add on something.
Yeah, I just wanted to ask Ankit, maybe if you could also touch on what is the impact to the employee shareholder or the common stockholder of this additional structure that comes into the cap table in this new style of round?
Exactly, and I think that all these structures in your waterfall almost disproportionately impacts the common shareholders, which are usually the employees and the management. And it's really important to take into consideration the impact of the structure in financing from the perspective of getting the right value for your stock when you're thinking about your options. So the one caveat that we always are trying to watch out for while making new investments is, do you see some of these highly structured deals, and how do you discount for that? And our technology and data team does a good job of looking at the latest cap tables and how do you incorporate these non-standard terms and the impact it has on the common stock valuation, and do that in a consistent manner over time. But it's just very clear looking at this chart that late stage venture over time has definitely picked up in terms of prevalence of things like liquidation preference of more than 1x. The other key point I wanted to highlight, which is again very important to appreciate, that post-market correction, I think there was a little bit of like fear in the market sentiment in terms of reallocating to quality names. So there was definitely a flight to quality effect that happened. And what that has led up to is concentration of market cap that is at an all-time high in decades. And I think we all had an intuitive sense of, like, when you read news, that the big is getting bigger, but I think the extent of concentration is just staggering. And notably, the concentration is not commensurate with the earning distribution, meaning it's not that the top 7 names or the top 10 names, whichever way you look at it, are actually growing more in net income to be able to command a higher market cap. It's really the valuation multiples of these companies that have really expanded, which arguably is again not sustainable. And if history is any indication, like when you look at some of these concentration peaks, what followed after those concentration peaks was almost a rotation back into small cap companies, which grow faster and over time like deliver returns. So on the left side of this page, what you see is, you did see similar concentration levels in like late 1900s, early 2000s, and it was quickly followed up by small caps catching up, and we are somewhat in that territory of it's hard to call the bottom for those small caps, but we did experience somewhat similar rotation into small cap over the summer, where a lot of these big 5 or the top 10 stocks actually had a negative correction, and the Russell 2000, which is a basket of like small cap sort of securities, actually appreciated. So that rotation definitely has happened in the past. We saw some glimpses of it over the summer, but I wouldn't be surprised if that's as people get comfortable with the health of economy and do try to diversify outside of just 5 or 10 names in public or private markets, that this is something that you see more of in future. Then lastly, I wanted to, in the context of market update, wanted to cover secondary markets. That's directly relevant to the area that we operate in. And net, I think we track several indicators to monitor the health of secondary markets. The leftmost chart that you see here is just the volumes that has happened or quarter across all the platforms that we are connected with and we get routinely data from. And there has been a very consistent sort of uptick in the market. So it's good to see more executed trades being done. And also when you dig deeper and you look at the depth of these markets, as we measure from the indication of interest being out there, which is almost like a step deeper than the final executed trades, you see a greater balance between bid and ask. And I think that's extremely important, because that signals that the distress in the market that was there about a year or two ago is now become more balanced, right? Like, if you look at the chart in the middle, about 12 to 18 months ago, there were a lot more sellers asking for prices that investors were not willing to pay, and there were not a lot of people who wanted exposure to those names or those prices. And that has definitely tipped over to become almost like 50-50 this year. So I think that's another indicator that sort of speaks to the efficiencies of the market and our confidence in the price discovery. And then lastly, if you look at this is a chart that we spent a lot of time on, the rightmost chart, which is showing you at what prices common stocks have been trading in secondary market as a percentage of last preferred financing. And it's tough to call out the bottoms, but we do, based on this analysis, do see that now there's an upward trend in those discounts. And partly that's because more financings are being done, and generally recent financings carry a lesser discount than the ones that happened 2 or 3 years ago prior to market correction. But in general, like, I think the discounts in secondary markets are recovering, and which sort of speaks to that people are not just trying to get in at distressed prices. You're actually seeing more confidence that people are willing to pay to get access to these names. With that, I'll spend some time on the fund updates. I think it's important to obviously put all this market backdrop in the context of our funds and you as LPs, understanding how we think about the fund's investment philosophy, where are we today, and what the outlook could look like. Kicking it off with the philosophy first, I think one point, or like in terms of philosophy, I think it's good to understand like what all do we need to believe in for these funds to actually deliver value to our LPs, right? And one of the first pillars to me is that companies are staying private for longer than they were before, and they grow significantly faster than the public peers, right? So we routinely see companies in our portfolio outside growing at more than 30 to 40% growth rate, which I think is definitely an attractive profile. The second thing that you need to believe in is that when you're entering these companies, you're not overpaying, because the growth may not matter if you overpaid while you are actually investing in these companies, and that's where we try to be very disciplined in terms of our entry point into these companies. I think in general, if you step back, it's a good macro environment to be coming into these companies, because they've somewhat just come off the peak and into a trough, and the discounts are high and all those things. But also on a name-by-name basis, right? Like, thinking about what valuation multiples are we paying. We are rejecting so many companies in the AI space because the company was just founded this year and is raising money at $1 billion Series A. I mean, that just doesn't make sense, or a 40 times multiple. So I think you need to believe that companies in this stage of their trajectory grow faster, which I think is, has been the case for a long time. And then you are at a capital market cycle phase where you are entering at a point where it's an attractive entry point, and you're being disciplined about pricing and valuation, and you are not overpaying for this. And the last thing that you need to believe is that you need to be staying invested for an investment horizon for this to play out. And venture as an asset class is generally like a long-term asset. So I think staying invested for 3 to 5 years, I think is the recommended hold period from our perspective, because a lot of times, you may come in and the company hasn't raised yet, so their growth is not translating into markups, and you don't see that into the LP updates that we share with you. We strive to do that every quarter, but I think you really need to be thinking of this as a long-term hold than something on a quarterly basis. And I think it's many of you would have heard this, that especially when it comes to alternative assets, like time spent in market is almost as important as timing the market. So while we feel good about the capital market cycle entry point today and the discount that we're seeing, for the growth story to play out and for us to see that in the fund returns, you have to be staying invested for a several-year period as opposed to several quarters. What you see on the right side is like how that philosophy has translated into where the portfolio is today. It's about 24 companies, and we have, I think, crossed 43 million in AUM as of earlier this month. And that's pretty strong inflows, because I think we started the year at about 14 million AUM, and that has grown into 43 million, primarily driven by new inflows, but also some modest appreciation in existing names. In terms of the mix across sector and market cap, I think we are well diversified, and that continues to be one of our pillars as we construct the portfolio. It's important that we continue to add more companies to the portfolio. Our target portfolio is to be more than 100 plus companies, and we are at 24, and we are adding new names rapidly. So diversification is one thing that we're definitely focused on as we grow the portfolio. In terms of performance itself, I think we have been benchmarking, as you may have seen in our LP reportings that we have done, against the Forbes Private Market Index, and we clearly have outperformed the benchmark. But I would say that we are, at least so far, a little shy of where we would expect the target returns to be. And the reason for that is, again, like, when you think about our portfolio, 24 names, and even if we see a lot of growth intrinsically in those companies, that translates to the write-up or the P&L. One, that companies raising new money. That's really the point of markups, and not many of the companies that we have invested in so far have had a new financing to be able to see that mark. So to me, I think the outlook, be it Cerberus looking for IPO or be like a couple of M&As that we are hearing from the management teams, I think in coming quarters or years, we'll see the latent growth that we have seen in this company translate into fund returns. But that has not happened so far, and I did want to acknowledge that and share that.
Well, and Ankit and or Jeff, before we move on, just maybe it'd be helpful to remind the LPs just what the selection criteria is for companies in the portfolio. Why do we turn down 90% of the companies? What is how do we define quality in the portfolio?
Yeah, no, that's really important. I think we think of it as almost like a two-axis framework. Like one is focused around there's certain filtering criteria we have. We want to focus only on companies that have demonstrated product market fit, are of a certain stage, need growth capital, and have had raised significant money so that we can derive comfort in its pricing based on the last round price and those kind of things. And if you apply that, which is to be specific, a 600 million minimum valuation and 100 million minimum raised in the last round, 200 million raised cumulatively, that sort of narrows down your universe to about 1,300 companies. And of those then 1,300 companies, every week we have our investment committee process to talk about how do we feel about just the macro environment, the industry dynamics, the specific company. How do we think about pricing and valuation based on all the data that we get from our data partners with folks like Force, Nasdaq Private Markets, Nazzaro, and others. Or in cases where we have direct information from the management team, either publicly available or pursuant to an NDA with them or a data room access. You try to maximize the data available to be able to price those companies. So it's a mix of qualitative and quantitative sort of approach to eventually make an investment decision. And as Greg was saying, like I think of those 1,300 companies, we have target portfolio of about 120 names, so a selection rate of about 10%, which I think is a great balance between you're targeting the top decile, but it still is a big number to be diversified across all of them. Because again, our principle for the fund is be diversified, choose companies which are high growth, don't overpay for them, and then it's a matter of time that it will translate into returns.
Thank you.
Just to add one thing quickly to that, and people sometimes confuse when you hear late stage VC. These are all late stage companies, right? There are no startups. They've all comfortably hit product market fit. All of our companies are doing comfortably over 100, some of them 500 million in revenues plus. All these companies years ago would have been publicly traded. They're choosing to stay in this private wrapper a lot longer. And if you want to access that growth, you have to access it in a vehicle like this or another vehicle. So just, agree with all of Ankit's points.
And one last comment I'll make on this page is, as you can see, not all companies are equal here. And whenever we are doubling down on a certain company, the top two positions that we see here, we've seen tremendous growth in them, and we're carrying them at like 4 times revenue multiple. So it's really important that wherever available, we do look at revenue multiples as well, because yes, you could be growing at 40%, but if you paid 40 times for a company growing 40%, they have to grow a lot for you to grow into your valuation. And we are definitely very value oriented, and we are happy to pass on some of the momentum based shiny objects which are raising a lot of capital at ridiculous multiples. All right, so with that, maybe I'll hand it over back to you, Jeff, for Q&As.
Sure. So thanks everybody. We were able to collect some questions from LPs and partners ahead of the call, and we'll try to run through a couple of these key topics. And I'll ask Greg and Ankit to help me. So, first question from an investor is, where do you see Collective over the next year or two? A little bit more of a strategic question. I don't know, Greg, if you could share some thoughts with us.
Sure. So I think our focus at Collective is both to scale the size and the volume of the products that we currently focus on, the funds that we currently focus on. So exchanges, building the exchange funds, adding new companies, and exchange loans, and those that are borrowing against their LP interest to create liquidity. And we'll do that both by bringing new companies into the portfolio, by doing larger transactions. We've been very, I think, disciplined around maintaining our diversification targets. So what that has meant, as we started as a very small fund, is that we could do very small transactions, because you couldn't do one $10 million transaction in a $11 million portfolio. But now, as that denominator grows, we're able to do larger and larger transactions. So we've now started to do our first 3 million, and we're now talking to people about the first $5 million transactions. And so we see, we feel like we've kind of laid the foundation, gotten on or become shareholders of 24, 25 companies. And so we see targeting something like 50 to 60 companies in the portfolio at the end of next year, and doing ever larger transaction sizes. And ultimately, we look forward to engaging with issuers directly and doing issuer-sponsored programs. And that can be alongside of tender offer programs or separately. We think of them as quite complementary. It's just a different tax-optimized solution as compared to a sale. And some employees and shareholders will find a better fit with one of those products or the other. But I think companies offering both will serve their employees best. But in addition to sort of growing what we're already doing, we also think of alternative use cases that we'll be bringing to market for our exchange fund. So if part of our vision and our mission is to create better wealth management solutions, initially diversification and liquidity, we can extend and use the exchange fund for other wealth management strategies as well. So we're talking about and partnering with others in the donor advised fund space, which is a great tax optimization strategy that is made remarkably more efficient by integrating our fund into the process. And we'll be talking to all of you about how that's the case. But for those that are looking for an immediate write-off to shield maybe income from selling shares or from other gains they might have, it's a really great wealth management tool to shield that income from tax. And of course, has the great added benefit of enabling people to give to their favorite charities in a really convenient, easy way. And similarly, people or our customers and LPs will encourage to use their LP interest in the exchange fund to start charitable remainder trusts. So if there's the sort of underlying common theme here are behind all of our products, the exchanges, the exchange fund, the exchange loans, donor advised funds, charitable remainder trusts. What we're doing is looking at the sorts of wealth management tools that public company executives use every day and take for granted, and benefit from enormously in creating long-term wealth plans or wealth management plans, and finding a way to bring them to the private market, using our exchange fund as a sort of key to unlock the value and make those shares that are today illiquid and therefore not usable for many of these wealth management strategies, and turning them into an LP interest in our fund, which is usable for these strategies. So we think we'll be diversifying by product as well as by getting bigger and better at the things we already do.
All right, thanks, Greg. Have a question here from an exchange fund LP. Really, Ankit, you've already touched on some of this, but could you talk about fund performance in the context of public markets, and what type of returns should people expect and what type of hold period? So you already touched on this a little bit. I don't know, anything else you would add to that?
Yeah, no, and I should have said, we do circulate our fund fact sheet with detailed metrics to all of you, existing LPs and whoever is interested from a potential LP perspective. And more information is available upon request. But I think in question of like thinking about fund performance this year vis-a-vis, how do you put it in context of not just the private market benchmark, but holistically, if I have capital allocated to this fund, how is that performing vis-a-vis public equities or US Treasuries, and how do I make sense of risk-adjusted returns of this fund? I think the fact is that we're probably going to end the year at high single-digit returns for the funds, which wouldn't be a surprise. That is lesser than the public equities returns. So if you look at S&P 500 this year has been on a tear, and they've far outperformed any other asset class. So there's a bit of reconciliation to be done, and I think the right way to look at it is to not really just think of this 1 year at a time, because in one particular year, any particular asset class could outperform another, and it's really hard to pick which year is going to be for which asset class. So if you look at the long-term returns and go back in time, like several decades, and the long-term VC returns over a 20+ year period has been around like 15 to 18%, and that compares to around 8 to 12% for S&P 500 kind of product, right? So it's, I think if you do take a long-term view on this, because it's hard to predict year on year what exactly is going to happen, then definitely there is some alpha to be gained by allocating to venture. But at the same time, if you look at just 2024, obviously public equities outperformed, and the delta between, call it venture and even US Treasuries, have not been as much. But again, it goes back to, you see this, like these things are somewhat cyclical, and they catch up over time. And when they catch up, they tend to like compensate for the prior lag. And that's why, like, be it valuation multiples, be it asset returns, but it's really important. That's why to think of this as a long-term asset, which has over a longer period of time consistently delivered better performance than public equities or other sources. And to be clear, like our target return for the exchange fund is 12 to 15%, given it also has 20% allocation to real estate. And for the liquidity fund, it's 15 to 18%, consistent with long-term VC averages.
Greg, maybe you just could add one more point on that. And any considerations LPs, especially exchangers, should think about the importance of tax deferral in there?
Sure, and that is one of the unique aspects to our fund. It's not only exposure to a diversified pool of leading unicorns, rather, but it's also the tax advantage from that exchange structure is enormously powerful in its impact on the ability to build long-term wealth. And essentially what you're doing as an LP, as an exchanger, is you're taking your tax savings, which depends on your tax situation, whether you're long-term capital gains or short-term capital gains, but for most of our customers, they've only recently exercised their options, and therefore, and I'll just pick a state like California, where many of us are, that tax rate on short-term sale of shares is 46%, state and federal, and maybe there's a brokerage fee of another 5 or 6%. So you're taking that, call it 50 cents on the dollar, that you would have had to pay in taxes and fees, and you're putting it into a venture fund tax-free and having it compound over time. And when you compound over time, it just, at any percentage, that has great power. But if you're doing it at long-term venture rates of, as Ankit said, 12 to 15%, it can result just in a multiple of what you would have gotten had you just sold your share. So I know I'm preaching to the choir because I'm talking to our LPs, but really that is, for those of us at Collective, one of the things that we feel best about and we're most sure about is the simple power of saving on taxes and using that savings to compound over time. Does that answer the question, Jennifer?
Yeah, that makes sense. One last question from a tech exec, exchanger LP as well. This comes up periodically from our client success team too. Is that question is, why can't I exchange more of my shares into the fund? And so, Greg and Ankit both touched on this earlier, is that, from the very beginning, pre-launch, our IC and management team and investment team have been steadfast around the importance of quality and risk management, and turned away hundreds of millions of dollars in transactions for either of those reasons. Resisted that temptation to grow the fund. We think that's the right thing to do. But the good news is, and Greg talked about this over the next couple of years, that we do expect significant increase in quality names as well as assets. So we do expect to be able to come back to people that are looking to exchange when we have more capacity to do that. So I don't know if Greg or Ankit would add anything else to that.
I think that's well said. Yeah.
All right, great.
Maybe with an eye on time, Jeff, do you want to maybe move
Yeah.
to?
Sure. Why don't I'll keep this brief just to try to keep us on time. But when thinking about closing remarks and this event in general, I was really thinking about what for me has been a North Star message that I really actually resonated when it came from one of our early exchanger LPs, one of our really cool portfolio holdings. He said, as we were explaining our exchange fund product and how it worked, he said, "Wow, this is really cool. It's really like a collective of founders, and I'd love to be involved." That word "involved" resonated with me. And when I think about, and Greg talked about this a bit at the beginning as well, but when I really think about our LPs and partners are really a collective that includes both leaders of and investors in this impressive group, rapidly growing group of private growth companies. And when expanding on that, when I think, what are we really trying to do here at Collective? It's, first, we really truly love the opportunity to engage with people. So whether you're a tech executive looking for guidance around risk, liquidity, long-term wealth, investor trying to figure out how to get exposure to this asset class, we're happy to share our thoughts, and we're equally happy to open up our networks, introduce people to each other, just to try to help find the right solutions, whether it's Collective or our advisors and other smart people we know in the market. Second, this time of year is always the time of year when we really reflect on what should we be appreciative of and grateful for. And a lot of people on this call have helped Collective grow and get to where the company is today. And whether that's founders and executives who liked our solutions and were kind enough to refer us to their peers or other companies we should look at, or in another case, a really impressive product leader who was at one of our portfolio companies and has moved on to launch his new company, has been really helpful in our investment process, and advising the IC on different occasions. Just think about the really deep, broad domain expertise that is in our LP base, and how we can continue to explore and use that more, and LPs can increasingly help each other, right? And lastly, for our partners, and we think of our partners as the companies themselves, best-in-class financial advisors. We were really keen to work more closely together in 2025, and I know there's a lot more we can continue to do together. So, I just wanted to say thank you to everyone for joining today, especially all of our LPs on the call for your confidence. And we love interacting with you guys, and look forward to doing more going forward. And wish everybody a very happy end of the year and a very prosperous 2025. So with that, thank you, everyone.
Thanks, everyone. Cheers. Thank you.
Bye-bye. Thanks, guys.
Collective Liquidity. Free your wealth now.